morning and welcome to CBRE Private Wealth Series. I'm joined by Will Carman, Trent Hobart and Yosh Mendis.
Thanks for having us.
Good morning.
Good morning.
I am so excited to be here beyond the portfolio as we welcome our development experts, Trent and Will. This month we launched District, and for the first time ever, what we've been able to do is produce all of our development offering across Australia to all of our clientele. And the development sites are so diverse. Will, talk to me about the development site you're bringing to market at the moment. It's a massive one. What is it?
Yeah, thanks, Ingrid. So we've got a large portfolio of 5 masterplan sites for the state government in Northshore and Hamilton, which is one of the biggest development sites on the market in Queensland at the moment. So we're really excited by that. We're working with Trent closely on that campaign with the state. So that's a really exciting one that we've been able to talk to a lot of local and international and interstate developers on that.
And what's going on in Brisbane? What's the state government trying to achieve? What are the market factors driving development in Brisbane at the moment?
Yeah, so not just Queensland, but I think across the country we're seeing a huge supply there's a lot of demand for residential accommodation across the nation, and what you're seeing with every state government around Australia is the need to deliver more dwellings in each of their residential markets. So that's no different to Queensland. The Queensland state government's doing a fantastic job. They've just announced what they call the LAP, which is the Land Activation Program. So they're taking surplus government land, activating that through planning outcomes or enabling infrastructure to make sure that good dwellings are getting put onto the ground and actually being built. And two of the things that we're doing at the moment are a part of that program.
And in relation to these sites, especially where we're doing housing and residential development, Trent, talk to me about BTR versus BTS. What are they and what's the differences?
Sure. Well, they're two very distinct markets. The build-to-rent market is really the evolution of the rental market in Australia, whereby really offshore global capital now has the opportunity to invest in the residential sector in Australia. Melbourne is undoubtedly the capital city for build-to-rent in Australia, and we've had a huge amount of investment over the past 10-year period in Melbourne, and now that investment is flowing into the other states, like obviously up in Brisbane. We're getting a lot more supply coming through now, and the Sydney market as well.
Trent, what are the current build-to-rent sites that have come to fruition, and what are some of the ones on the books now that are going to be coming out of the ground? Where would I see these in Melbourne?
The supply for the build-to-rent market has really been centred in Melbourne, in the city fringe of Melbourne, so from the CBD out to about 5 kilometres from the CBD. The reason being that that's where the majority of Melburnians want to live, and it's close to transport nodes, close to retail amenity.
And does a build-to-rent building look different to a build-to-sell, for example? So is it lower quality, higher quality? Are they larger? Are they smaller? Is there different car parking? What makes a build-to-rent?
Sure. One of the most exciting transactions I was involved in was the Richmond Plaza transaction, whereby Home bought that back in about 2018 from Coles. That's a perfect example of a build-to-rent asset, whereas 350 apartments all integrated through ground-level retail. So you've got a full-line Coles supermarket and about 30 specialties there. So what it's got essentially is a highly amenitized building, so where the residents can work, live, shop, dine and play.
Wow. And are there any other sites like that outside of, the Richmond one is an incredible site, which, funny enough, you should say that because that's one of my first ever managements. I used to manage that property, and in actual fact, in another life, Burgess Rawson sold that to Coles. So that's an amazing fruition of that site. What other sites are like that? The Richmond one is beautiful. I've driven past that a million times. Where else would I see them in Melbourne?
Look, we're really excited to see the completion of the Rayleigh in Windsor. That's being undertaken by Goldfields, one of our great clients. That's about 350 apartments as well in the Windsor precinct, which is, we think, the best rental market in Melbourne. One of the most beautiful buildings that's ever going to be finished in Melbourne. So that building's going to have a whole level of co-working at the ground floor and retail. Then it's going to have facilities such as vertical dog walk parks on level 9. It's got golf simulation, dog washers in the basement, and then it's got a whole level of rooftop amenity on the rooftop, which is going to include gym, pool, outdoor pool, spa, sauna, Pilates. It's going to have everything. Essentially for the residents of that building, they're not going to need to leave the building. It's a whole precinct within one building.
Is that? I find that really interesting. We're across the market, we're all hearing about this build to rent. I think we're hearing about it a lot in a variety of different sources. What's creating this shift into the market, hearing so much more about this build-to-rent market picking up and taking over a bit more of that development space?
Oh, look, I think it really got the evolution of it came, it was big in America, then huge in Europe. And really, the global pension fund money wanted exposure to the Australian residential market.
But at scale, I suppose. And you can't get scale without BTR.
Well, that's right. And, if you think about a build-to-sell project, you come in, you make your money, and then the money goes back out. For this, it's long-term investment. It's long-term stabilised investment for global capital. And, now we're seeing the second evolution of that, whereas the Australian REITs and superannuation funds are now investing heavily into this market. It's taken time, but they're getting there.
Fantastic. And construction costs, does that start to impact kind of those markets at the moment for you guys?
Construction costs?
Yeah.
Yeah, sure. I mean, no one's immune to construction costs throughout Australia. Yeah. We did have increases in construction costs through the, 2021 to 2023. That's stabilised now. So the good thing about our market is that developers can now accurately price projects. Yep. Costs have gone up, they're stable. So that's okay.
I was also reading about, obviously, the effect of things like government fees in New South Wales and developer fees and things like that, changing those feasibilities. On one hand, in the build-to-rent space, I understand we've got a lot of government support financially, but then on the other hand, have we got planning controls that are costing developers more? What are you seeing at a macro level affecting developers?
There's no doubt there's a supply-demand imbalance, and we've had huge population growth here in Melbourne, as has Queensland. We haven't had enough supply of residential stock throughout the inner city and outer city markets over the past 5 years. There's actually a growing undersupply. So what we're seeing now is governments have had to change our planning regimes. We've now introduced the Development Facilitation Program in Melbourne to fast-track permits. We're now getting permits that far exceed the former planning guidelines. So that's a good thing because
so give us an example of what that means
supplies.
to developers, though. Give me an example of that.
Yeah, sure. So we're involved in an awesome site down on St Kilda Road, 636 St Kilda Road. That particular site is about a 5,500 metre site. That had a preferred height limit of about 60 metres. And that one's just had a planning outcome which far exceeds the former planning guidelines. And what that means is, for an incoming developer, they're able to assist the government's intention to provide new housing to Melbourne and more housing for sites like that, which are premium sites that are going to suit a whole range of the market. From it could even include build to rent and downsizing owner occupiers on that particular site. Unbelievable view lines. And what it means is that governments are now seeing the need to create extra residential supply, and they're helping developers facilitate that.
And are you seeing the same thing in Queensland, Will? Are you is this a government? Is this something? Albeit we have state government, is this happening across Australia?
Yeah, it absolutely is, and I think it's being driven by all layers of government. So the federal, the state, and then also the local councils are playing a big part in increased densities and height limits around infrastructure and retail amenity and transport that actually makes sense, where people genuinely want to live. I think the other thing you've seen that's moved over the last 5 years is infrastructure is harder to deliver on the outside parts of the CBD. So it's genuinely harder for residential subdivision to continue the supply that the demand is there. So
infill versus urban sprawl, for example.
Yeah, correct, exactly.
And allowing for, facilitating infill by planning regulations and by government support.
Yeah, correct. And there seems to be a theme across all of Australia of increased densities around transport nodes, and then also people activating surplus government land. It's unbelievable how much government land is there, and they're activating this through triggers they can pull to make sure that dwellings are being built.
And whilst, of course, we've had huge house price growth in Brisbane, I am sitting next to the New South Wales and who are the most expensive house prices almost in the world over in Sydney. What's going on there? I mean, I know that within district we're bringing a number of sites. We've got some 8 or 9 sites that we're bringing to market. But on top of that as well, our development specialist, Alex Mazane and Ben Wicks, have also got a number of really high-profile sites that they've got on the market. What's going on in Sydney, and how is Sydney and New South Wales, wider New South Wales, responding to the development needs?
So certainly in Sydney, I think, overall, I think certainly as one of the most densified cities in Australia, land allocation is difficult. We are seeing some significant growth corridors in the west, because certainly that's where the available opportunities are. Certainly in the the Greater West and Southwest precincts of Sydney, where you're seeing probably the most activation at the moment, particularly given the recent particularly given obviously the new Western Sydney Airport. That's created an amazing hub for that Western corridor. So I think that's really going to continue driving that central core precinct that continues to I guess, radiate out. So there's certainly a number of investors and owners who have owned blocks of land out there for the last 40 years who have sold those for an amazing pricing and have turned it into a more investment product now. So, it's a really nice probably ecosystem that we're seeing for product clients that we're dealing with on the development side of things who are now recycling that capital into some of that investment product that we're selling in portfolio.
No, I think there's an amazing connection there. And Trent, obviously you're the leader of our development segment within CBRE. We've just rated number 1 in the MSCI ratings as the largest seller of these sites. Talk to me about your view of development across Australia as the head of development. What's next for CBRE in 2026?
Well, I think developments is certainly the most exciting asset class.
We might argue.
And look, I mean, our market's always changing and different parts of the market go in different cycles. So, we've talked about the build-to-rent market, which has been booming because of rental growth over the last 5 years. We're now seeing with construction costs, there was a slowdown in build-to-sell apartment buildings throughout Australia. What we're now seeing is a whole new wave of pricing for build-to-sell apartment buildings, and the market in Melbourne is now accepting of those pricing. You used to be able to develop for, call it $10,000 to $15,000 a square metre, and developers used to make money. Now we're seeing consistently 18 to 25 and up to 30,000 a metre for these new age, higher quality, highly amenitized buildings that are coming out of the ground in Melbourne. The third part of the market that we haven't really spoken about yet is the greenfield or subdivision markets. Such an exciting market, and it's one that's probably been at the lower point of their cycle for the last few years. What we're now seeing is developers, their sales rates are back. Once again, they're now achieving the new age of pricing for the house and land packages that they needed to, given increased construction costs. The first home buyers are back and the second home buyers are back in that space. So those markets are back to getting, somewhere between 15 and 30 lot sales a month for those premium subdivisions, which is excellent for our market.
And in that subdivision market, while we're talking about it, are you seeing, probably other segments within, or I should say other states in Australia that are probably more robust than others?
Look, those markets, each city is very different. I mean, Ben and Alex have had great success selling subdivisions in Sydney, but they're very hard to come by. Obviously, the land's tightly held. The Queensland market's been burgeoning over the last 10 years, and we don't see any signs of stopping in that space.
Yeah.
And then, the Perth market's probably been one of the strongest sectors, strongest cities for the subdivision space over the last 5 years. It's had exceptional growth.
And do you find a lot of cross-pollination across the developers? Like you mentioned guys like Goldfields and things like that. I know they've done some significant projects in SEQ, whether that's buying land or selling land. But you're talking about Perth markets. Are you seeing a lot of those eastern seaboard type developers going to the west for opportunities?
Absolutely.
Yeah, half of Victoria's in Queensland at the moment.
Yeah. Yeah, we were lucky enough to sell a large subdivision site in Dingley Village to Nigel Sadley from Perth. So he bought a former golf course, the former Kingswood Golf Club out there a couple of years ago off us. He's just got his permit through. He was expecting 800 lots. He's just got a permit through for 950 lots. So It's going to be an exceptional development down there. And you're seeing cross-state investment from. They're really national developers in that space now.
Yeah, wow.
And who are those players? Like, who are the national? I mean, I know that Meriton's now building in Brisbane at the moment and Sydney, etc. But who are those national players?
Oh, look, there's a lot of them. Obviously, there's the listed property funds who are doing it, like your Stocklands and your Mirvacs and whatnot. Then you've got your large private players like your Villawoods, Oriana, Goldfields, as we've discussed.
And then you've got your smaller sites as well. Because I mean, if I look at district, it's anything from 1 to 200 plus million. So obviously we've talked extensively about the residential side of the development sites that we are transacting. What about the commercial side? What about the sort of stuff that we're with that, sites that you're selling to become future QSR or future LFR sites? What's going on there, Will?
Yeah, I think over the last couple of years, you've seen that market be pretty slow because as construction pricing has moved, you've seen that sort of really stabilise. But the really exciting part that we've seen in the last couple of years is some really solid rent growth through some of the QSR, some of those bulky showroom retail groups. And Yosh, you would know that better than anyone, but we're still starting to see some of these big brands that are continuing to need their rollout to happen, and there's some significant rent growth in these markets.
And it's about feasibility, right? Like,
It is.
if we look at the side of, in our world, we sell the finished product, and we know that brand new finished product with depreciation benefits sell for far sharper yields than secondary products. So there's a yield play, there's a rent play, and it's a connection between the tenant and the developer, really, isn't it? That's what you see, Yosh.
Yeah, absolutely. I think they're like to Will's point. I think there was a point in time where some of those supply pipelines started to get a little bit more trim. It was more of a scenario of trying to find adequate land holdings that were going to work for some of these tenants. Planning provisions were starting to get a bit difficult for some of these developers, but overarching everything was construction costs. I think at the end of the day, that was starting to make it a bit prohibitive for some of these developments to stack, and that's where rents had to really catch up. And we have seen that rent growth. I remember, remember 10 years ago we were selling fast foods at 150s. Now they're 250s.
Not
now
even
they're
10.
300s. Now
That was
they're 400s.
5 years ago.
Yeah.
You were at 150 fast food.
That's right, and we're now getting them at. I'm advising developers on rents for fast foods at 400 plus now. I've heard of one at 600 plus. So these are the type of numbers that need to be done for businesses to actually get a foothold in the Australian market, whether in metropolitan locations or out into regional locations. Again, that is the same for large format retail. Rents have to catch up. That market has pushed, and it is not everything is working for everyone, but it is certainly, I think things have caught up to a point where these developments are now stacking for developers, similar to what Trent was saying in the resi space, and we are still seeing as constrained development pipelines for a lot of people. But there are projects that are coming out of the ground now that, 18 months ago was probably not feasible, but now rents have caught up where they've gone, we can make this work.
And I think too, just how robust that sector is. We were talking about a couple of years ago how that slowed, and I think you would know this better than me, but as interest rates and cash rates moved, but you can see how that is not changed at all in terms of yields and cap rates, and it's really stabilised, and it's a really robust sector. So from the developers that we're talking to, they've got great certainty when they're building this, that there's a really good understanding of where it's going to land at the back end, because that yield curve hasn't moved as cash has.
Yep.
So
And we were actually with our research, we were mapping the movements of fast food over the rate rise cycle, and in actual fact, there was about a 20 basis point move in total for quality fast food, as distinct from 13 rate rises. So I think there's a lot of confidence that's given there that you do know where you're going to come out the other end. But moreover, I think that investors are also willing to accept those rents and still pay sharp yields for them because they are now the market, and that's a mental shift for the end product.
Well, it's funny you say that because I remember when we had this conversation a little while ago around, when we saw these rents at say, 200s and 250s. And at that point in time, say for a Guzman Gomez or a Hungry Jack's, we were going, oh, this is the new rent. But now that's the cheap rent. That's the low rent in the market now. So, and I think that market will continue to evolutionise over that time, and these rents will continue to grow. They have to. It doesn't matter if it's residential, commercial. These things will continue to move, and I think it will always be a challenge for developers to build these projects. That market is always going to be tight. It doesn't matter if it's today or 10 years ago. That market has always been quite tight. So I think at the end of the day, it's not like that's changing drastically, but at least when these rents are moving, it is making some of these projects actually work. The other thing is deal structures are changing a little bit, I'm finding. I find that as the confidence in the market is coming through, obviously auction portfolio continues to be a success in that investment space, and it always has been and always will be. But I am finding that because the supply of these projects are getting tighter, people are trying to get their foot on projects a bit earlier. So, last year we sold, a number of Sydney service stations and fast food assets from a variety of different price points via fund-throughs. And because basically it was a scenario where there was no product available on the market, say in Metro Sydney, and people were going, well, I said, I've got a product that's coming up in 6 months' time. Would you want to you buy it on completion? And they're signing contracts on empty land, just saying we'll see it when it's finished, just to put their foothold on it. And that's for as completed contracts. But even for fund-through buyers, we're seeing a number of investors now who have an underlying confidence in the tenant covenants that they're buying, but also the developers that are building it, and that at the stabiliser construction costs to actually do fund-through deals now. We just did a fund-through deal for a childcare centre out in Queensland, just under 10 million, up into 7-Eleven at 8 million. We've just done a convenience retail centre as a fund-through at 25 million, and people are willing to get their foot on these assets early and create more favourable deal structure for themselves, because they can get that confidence knowing that they'll see that project out to completion.
Mm. And, Will, came back to the Hamilton Northshore because I think it's just the most incredible site. In 5 years' time, when I look at that area, what am I going to see? What's it going to look like?
That's it's pretty exciting. And we're genuinely really excited.
Give me the
by
vision.
It.
What am I going to look at when I look at that vacant space?
Yeah. So that location can house 300 dwellings. 3,000 dwellings. So it's a huge precinct, and lots available on the river. Brisbane is exceptionally river centric. Everything revolves around the river. The state government has already tipped in $100 million to get these lots ready, so they're really keen to see these activated around the river. The state government's really keen to see the open space and the landscaping really activated. So what you're going to see is a really cool mixed-use precinct, similar to South Bank in that nature, where you've got really cool river activation, some ground floor retail, and then hopefully 3,000 people living there, enjoying there. One of the parcels that we are selling is a town centre parcel. So part of that is their feeling is more like if you're Brisbane, sort of a West Village type or a South City Square, where it's a Coles or Woolworths on the ground floor with some other retail with like a true mixed-use precinct. So in 5 years' time, it'll be a really thriving residential location where people want to live and they want to play and they want to enjoy that river.
It's a great thing about Brisbane being on the river. It's finite. There's only so many parcels of land on the river that can be activated, right? So, I think that's what's going to be really exciting about this project, where from what it sounds, to get a project of this scale on the water again is going to be very rare.
Yeah, and I think you've seen that move. Brisbane has evolved an absolute heap over the last 5 years, and then moving into a 2032 Olympic Games with all the infrastructure that we've got going on will continue to evolve, which is really exciting, where parcels of this size and scale in Brisbane where that you could build 400 to 600 units on probably wouldn't been able to be done. But now our city is at a state where you can do that, and there's the demand and the confidence in the local residential market that people are happy to punt that and feel really confident in what our market's going to be like in 10 years' time.
And obviously, CBRE has partnered with the state government in this situation, and the level of trust there. In selling this site, is it going to be one buyer, or is the town site going to be a different buyer? What does the buyer profile look like?
Yeah, so Trent and I were actually having quite a detailed conversation about that this morning, and the 5 lots we're selling will most definitely end up with probably 5 or more buyers of that nature. Because the key for the state government is really to be houses on ground. And dwellings being delivered, and if you sell all 5 to one buyer, then there's just not the chance that amount of dwellings can be delivered in that sort of time. So our inquiry schedule at the moment is absolutely dominated by local privates who have local building relationships and can get on the ground and start building before 2032. The other really cool thing that we're seeing is the entrance to our market of other builders. So, for instance, MaxCon at the moment is moved up into Queensland, Versatile. Some of these other groups are starting to open up their construction arms, and some of these groups, take it Kokoda, for instance, who is a Melbourne-based group, have got a relationship with MaxCon, have started building in Brisbane because now they've got that arm and that relationship with someone up there. So we're seeing a lot of interstate interest into these blocks as well. But yeah, quite dominated by local privates.
And that's what's exciting about District, is that we're able to bring these sites to the whole of Australia, and for everybody to have an opportunity to understand what they are, how they can transact to them, and how they can operate across Australia. Trent, you've obviously been in development for a very long time. You're an absolute expert. Tell me, what was your favourite ever development site that you've sold?
Well, I think as any real estate agent, you love being part of a transaction where you're making your vendor a lot of money. One of the most exciting deals that we've worked on was a large subdivision site in Point Cook where our client actually bought it for about $7 million. We ended up transacting it about 5 years later for 135 mil.
Wow.
So
That's amazing.
just exceptional growth for the investors that were in that deal, and just an exciting precinct in that Point Cook master plan community.
Will, we've obviously got a lot of conversations about interest rates, and the big four banks are predicting an interest rate increase. How does that affect development sites?
Yeah, good question. I think it definitely has affected development sites, and I think Yosh hit the nail on the head around deal structure in that commercial space, and you're seeing that even more prevalent in the residential market, where you're having some delayed settlement time frames for developers to make sure they've got the time to be able to get the development approval, to be able to get their builder ready to go. So we sold a parcel at Hamilton for Brookfield. That settles next week, and the builder's starting the week after. So you're really seeing those time frames really shorten up in terms of the holding cost for a developer.
That's a material difference.
It's a huge difference, and you've seen that change with the cost of debt too. People are wanting to push that cost back on to the vendor, but also it really helps in the pricing on the front end for what they're going to be able to achieve.
Yeah.
Ingrid, we're involved in a deal down in the Geelong precinct at the moment. Exciting project. It's actually permit approved for 700 plus houses, and that particular project, owned by two local families who've held the property for many, many years, it's generating a huge amount of interest from all the local, national and international subdivision developers.
Well, I think Geelong is a really special story because now with connectivity by way of train, the amenity that's being created, I mean, there is many Melburnians who are choosing to permanently relocate to Geelong. So Geelong itself is a changing region. Would you agree with that? What's happening in Geelong?
Oh, look, Geelong, the amenity in Geelong is fantastic. When you think of the investment that's been put into the waterfront precinct
Yes.
of Geelong, we've got the Spirit of Tasmania now leaving from Geelong. You've got the Ballerine Peninsula and all the wineries and golf courses and whatnot, which is fantastic. And then you got the Surf Coast. So it makes a hell of a lot of sense. Not to mention the best football team in the land.
And so this site that you're referring to as well. So again, what would it look like in 5 years' time when I come and look at this site in Geelong? What is the future vision? What does it look like?
Well, look, I think it's going to be the best subdivision site in all of Geelong. So it's the first site coming out of the old Geelong, if you will, coming down into that new Armstrong Creek precinct. And it's going to house somewhere between 700 and 1,000 houses. And I think they're going to be the most premium houses in that whole entire Armstrong Creek precinct.
And will there also be shopping centres, or is it going to rely on the Creek Central Shopping Centre? Would there be additional retail amenity?
Yeah, look, it's just north of the existing Armstrong Creek Town Centre, which has had a huge amount of retail put into there, and it's hugely successful. It's been undertaken by Welco. It will have a localised shopping centre within the precinct as well as having a huge amount of activated open space that's all planned within the PSP.
And explain that to me again. So like with Will's, where he's talking about potentially 5 buyers for 5 lots, is this one buyer for the whole site who also does the shopping centre, or is this 2 or 3, or what does that look like?
Look, it's one buyer, and look, at the moment there's probably going to be upwards of 10 offers on this site.
Wow.
And we're talking into the mid-$100 million range. So it's getting interest from everyone. It's very unique to be selling a subdivision site that is planning permit approved. So it's ready to go, so in a lot of cases, you're having to wait for the PSP or the permits to come through. This one, a developer can get straight into the development. And this one, I think it will be dominated by traditional housing stock, but it could also have a retirement village in there as well.
And we've seen a huge growth in the aged care space and the healthcare and social infrastructure space. So if it's ready to go, what does that look like from a time frame for you? Because I know that some of your transactions can be 1-2 years. Does that mean that we're seeing breaking of ground this year? What does that look like from a time frame?
Yeah, absolutely. I mean, this particular site, as I said, they'll be able to get on site essentially within the first couple of months.
Wow.
It'll still take a 5 to 6 year period to develop the whole site. But in terms of being able to mobilise their development teams, this one's shovel ready.
Wow. Well, I would like to thank you all for joining me today. This has been absolutely fascinating. CBRE also obviously has their global website with all of our listings and all of our available and our width and breadth of services. But very specially, we also have the CBRE Private Wealth Series site, which highlights all of our development sites. So Trent, if I needed to find out more, I want to know more how to access this style of property, sell, buy, what should I do?
There's a one-stop shopping group, CBREprivatewealthseries.com.au, where you can get online, have a look at what we've got on market, but of course we've got a lot of opportunities in the premium space off market. So I encourage you to contact our experts and we'll be able to direct you into the right properties to buy.
Fantastic. Well, thank you very much for joining me today.
Thank you, Ingrid.
Thanks, Ingrid.
Thank you.